Never before has a novelty-sized cardboard sign plunged the world into such chaos.
It's chaos.
Trump's Liberation Day tariffs have liberated trillions of dollars from the US stock market and fudded its fear and greed index all the way to 4. Global markets reeled in terror at a tariff spreadsheet that looked like it was outsourced to ChatGPT. But is this all part of the plan? And if so, why? Today, we find out. My name is Guy, and you are watching The Coin Bureau. Donald Trump's tariff spreadsheet may have just changed the world forever. Or not, because the tariffs might be gone by the time you're watching this. Or maybe they'll be higher. It's hard to say because US trade policy has become totally unpredictable in recent months. That said, Trump campaigned on promises to tariff the whole world, and he is delivering big time. But some of the objectives seem to be in tension. If the tariffs are a negotiating tool, they'll be removed or reduced sooner or later. But if the tariffs are a protectionist and revenue-generating measure, they probably need to stay in place. Mixed messages have been coming from the White House on how permanent or negotiable the tariffs are. But the consensus in the administration is that they are very good for America in any event. And they certainly made a big impact when they were announced. So, let's remind ourselves of what happened on Liberation Day. On the 2nd of April, Trump unveiled a sign showing new tariffs targeting more than 150 countries and territories, covering virtually all US trading partners and even including some islands without human inhabitants. He described the tariffs as retaliatory and specifically a retaliation against, quote, cheaters and scavengers for, quote, raping, looting, and pillaging the US. So the US will bring them to justice by tariffing them up the wazoo, something the American consumer will presumably have to pay for in the end. These tariffs are between 10% and 50%, with the highest reserved for exports from some of the world's poorest countries. 50% for Lesotho and Saint-Pierre and Miquelon, 49% for Cambodia, 48% for Laos, 47% for Madagascar, 44% for Myanmar. That'll teach them. Or rather, that'll teach Americans to stop buying all that vanilla from Madagascar and grow their own. Now, assuming that these tariffs are here to stay, they will force a permanent structural change to the world economy. They are the undoing of the 80-year project of trade liberalization led and institutionalized by the US through the General Agreement on Tariffs and Trade, the World Trade Organization, and the North America Free Trade Agreement, among other organizations and treaties. Trade liberalization was a boon for multinational corporations and the ruling class. It accelerated deindustrialization, dismissing workers and closing production facilities in wealthy countries like the US, only to outsource the same labour and production to wherever in the world had the lowest wages and the weakest labour and environmental protections. For workers in the US and elsewhere, the cost of labour was transformed into a global race to the bottom. For countries on the sharp end of trade liberalisation, the structural adjustment programmes of the World Bank and IMF enforced a model of extractivism that would have made the British East India Company blush. Globalists, finance capital, the ruling class, whatever you want to call them, the agents of this change were not 150-odd countries and territories scavenging, plundering, or raping the US. It was the consensus of the business interests in the United States and other wealthy countries. It's hard to ask for a better deal than having the world's poor produce goods for your consumption in exchange for a pittance. Now, Trump wants Americans to stitch their own sneakers, but what will they cost when you have to pay textile workers the federal minimum wage? Of course, if Nike, Adidas, and the rest of the gang don't move production to the US, then their shoes will be tariffed heavily on import. So, either way, it seems tariffs will send prices soaring. According to a projection by Rosenblatt Securities, the price of Apple's flagship iPhone, for example, could exceed $2,200 if Apple passes increased costs on to consumers, with some estimates being as high as $3,500. I mean, it's a great camera, and of course we all love Siri to bits, but that does seem a bit on the steep side, doesn't it? A price shock of this magnitude implies significant supply-side inflation, which UBS has predicted will settle around 5%, assuming Trump's Liberation Day tariffs become permanent. High inflation is likely to cause a pullback in domestic consumption. This, combined with retaliatory tariffs making American exports less competitive, is a recipe for economic contraction. 6 months of that and boom, you're in recession town, and some now believe that this is the most likely outcome. JP Morgan, for example, now expects the US economy to shrink in 2025 and 2026, with the recession expected to begin by the end of the year.
It's the place to be when you're in need of amazing crypto deals and opportunities. It's got savings that you won't believe, like money off those pesky trading fees. It's the Coin Bureau deals page. Sign up bonuses and discounts too. The Coin Bureau deals page. We put these deals together just for you, just for you.
To put things into perspective, the new average tariff rate of 29% that the US now has on other countries represents a more than tenfold increase over 2024, when it was 2.5%. The US hasn't had tariffs this high for almost a century, and there aren't many analogues in history for a country doing this to itself. But there is at least one. In 1930, the Smoot-Hawley Tariff Act raised tariffs in all sectors of the US economy to an average of around 20%. This was intended to shield American industries from foreign competition and encourage domestic employment, production, and consumption during the Great Depression, which had begun 8 months before. More than 1,000 of America's top economists pleaded with President Hoover to veto the bill. Henry Ford told him it was, quote, an economic stupidity, while the CEO of JP Morgan at the time said that he, quote, almost went down on his knees to beg Herbert Hoover to veto the asinine Hawley-Smoot tariff. Their argument was that the resultant trade war would pour fuel on the bonfire of the US economy rather than dampening it. History teaches us that this is precisely what happened next. Boycotts of American goods and threats of retaliatory tariffs were already underway overseas when the bill was passed in the House of Representatives in May 1929. After Hoover then signed the bill into law, dozens of America's trading partners, including Britain, France, Germany, and Canada, followed through on these threats and developed new trading partnerships and systems among themselves. Between 1929 and 1933, US imports fell by 66% and exports by 61%, and overall global trade fell by 2/3. The tariffs did not start the Great Depression, but the trade war they started was one of the reasons it was so dire. Smoot-Hawley is now remembered as a disastrous self-own that discredited isolationist trade policy. Although Trump did say on Liberation Day that the Great Depression was actually caused by tariffs not being high enough. So, I guess we'll never know. But anyway, back to 2025. Now, many have observed that the US economy has enjoyed an unusually long period of almost unbroken growth, and believe that a recession is now in some sense overdue. Meanwhile, the Federal Reserve has spent the last 3 years trying to wrest post-pandemic inflation back under control with rate adjustments of just the right amount and timing so as not to overdo it and tip the economy into recession. This is the fabled soft landing that most have been praying for, and it looked as though the Fed was just about to pull it off. This is another reason why the plainly inflationary tariffs are such a head-scratcher. It's almost as though someone saw the soft landing coming and deliberately sabotaged the landing gear at the last moment to engineer a crash. Well, it sounds crazy, but that might actually be the plan. So, why on earth would the government deliberately try to start a recession? Well, one theory suggests that the administration's real goal is to refinance its debt on the cheap by forcing down interest rates. For the Treasury, this would be a good time to have lower interest rates because the government has a large amount of debt coming to maturity that will need to be refinanced this year. As interest rates remain elevated from the 2022 inflationary environment, Repayments on US debt are expected to cost close to $1 trillion this year, or around 13.5% of the federal budget for 2025. Now, this doesn't bode well for the future because government debt is already more than $36 trillion and increasing at an alarming rate. If it were only possible to have the Federal Reserve reduce interest rates, the US could refinance a portion of this debt at a cheaper cost and kick the can a bit further down the road. Well, if you don't want to sit around twiddling your thumbs waiting for the rate-cutting cycle to play out, you could take a more proactive approach. If the Fed's motivation for cutting interest rates is a slowing economy, then why not just go ahead and slam on the brakes? Or, just drive the vehicle straight off a cliff. So, if the tariffs look like a car crash, then perhaps we should believe our eyes. After all, the purpose of a system is what it does. The tariffs will tank the economy, which will most likely prompt the Federal Reserve to lower interest rates significantly. Investors can be expected to flee from risk assets into the safety of US 10-year Treasury notes, pushing down their yields and, therefore, the size of the government's debt repayments. Now, evidence for this sequence of events includes Trump's frequent challenges to the Fed's legal and operational independence. He has openly criticized and discussed firing Jerome Powell. He has said that presidents should, quote, have a say in rate decisions, and cited his business credentials as superior to Fed officials' expertise. Trump has demanded Jerome Powell cut rates on at least 2 occasions this year. He did so in a speech at Davos and again 2 days after his Liberation Day tariffs announcement. Just minutes before the Fed chair was due to give a speech, Trump took to social media to demand he cut rates and, quote, stop playing politics, in all caps. Now, this theory might help to explain the puzzling formula that was used to calculate the tariffs unveiled on Liberation Day. They had been billed as reciprocal tariffs based on tariff rates charged by America's trading partners plus non-tariff barriers, but they were not. The rates Trump presented were quickly reverse-engineered by observers, including the economist James Surowiecki, who noted, quote, for every country, they just took our trade deficit with that country and divided it by the country's exports to us. Surowiecki explained, quote, so we have a $17.9 billion trade deficit with Indonesia. Its exports to us are $28 billion. $17.9 billion over $28 billion equals 64%, which Trump claims is the tariff rate Indonesia charges us. What extraordinary nonsense this is. Meanwhile, Thomas Sampson, associate professor at the London School of Economics, said, quote, the formula is reverse-engineered to rationalize charging tariffs on countries with which the US has a trade deficit. There is no economic rationale for doing this, and it will cost the global economy dearly. The plot then thickened when it was discovered that free AI chatbots, including ChatGPT, Gemini, Grok, and Claude, all spit out some version of this formula with remarkable consistency when asked for an easy way to solve trade deficits and put the US on an even playing field with its trading partners. We were also able to reproduce this on ChatGPT and Grok on our first attempt, although we didn't try Claude or Gemini. Anyway, the possible outsourcing of US trade policy to a free chatbot supports the notion that the tariffs are an act of self-sabotage. If their purpose is to tank the economy, then the less care and thought that's put into them, the better. Really, they should be as ham-fisted as possible to maximize fear, uncertainty, and doubt. All in service of the greater good of debt refinancing, of course. So the question is, how much greater is that good? Inflicting a recession on your country and perhaps the global economy sounds like a pretty high price to pay to get bond yields down a bit. Now, if you're not convinced by this theory, perhaps I can interest you in a variation, the so-called Mar-a-Lago Accord. This is the nickname that's been given to an essay by the chair of Trump's Council of Economic Advisers, Stephen Miran. In it, Miran outlines a plan to reschedule the US national debt by replacing outstanding Treasury bills with non-tradable century bonds or perpetual bonds. Trump has also made reference to this idea, while Treasury Secretary Scott Bessent has said that NATO members who are not pulling their weight financially should have to buy 50-year US government bonds. Any such rescheduling of the national debt would be a generational karate kick of the can down the road, but no independent country in their right mind would agree to it, especially not in the current climate of souring diplomatic relations with Washington. But perhaps they could be coerced into it using, say, tariffs. Now, admittedly, this is not quite the same thing as the plan to use tariffs to cause a recession in order to achieve low interest rates for debt refinancing. However, it is the same radical thinking that the second Trump administration has shown it is willing to apply to stave off a national debt spiral. Well, in any case, the tariffs appear designed to engineer maximum fear, uncertainty, and doubt, and this is exactly what they did. Days after Trump's announcement, the tariffs have activated a dip that just won't quit. The tariffs were announced on Wednesday, and by Friday, $6.4 trillion had evaporated from US stocks as trading volume on all US exchanges hit new all-time highs. It was the worst week for US stocks since the onset of the pandemic in 2020. The S&P 500, Dow Jones, and Nasdaq closed between 9 and 11% down from Wednesday. This put the Dow Jones in correction territory, the Nasdaq in a bear market. Meanwhile, the S&P suffered its biggest 48-hour drop ever. The CBOE Volatility Index, which measures investor anxiety, closed at its highest level since the beginning of the pandemic. Swedish fintech firm Klarna cancelled its upcoming US IPO, which had been anticipated as a catalyst for the recovery of the US IPO market. On the bright side, USDC issuer Circle may do the trick with its recently announced IPO, assuming, of course, it doesn't also delay. Anyway, in response to the bonfire on Wall Street, China said the market has spoken and declined Scott Bessent's request not to retaliate against the US for its new average tariff of 54% on Chinese imports. Instead, Beijing announced an additional 34% tariff on American imports, cancelled a deal to sell TikTok to the US, and introduced new export curbs on some rare earth minerals. English-language news media outlets in China have since been posting AI-generated videos making fun of Liberation Day. They feature scared consumers and robots dancing to songs with lyrics like, "You taxed each truck, you taxed each tire, Midwest burnin' in your dumpster fire," and "Liberation Day, you promised us the stars, but tariffs killed our cheap Chinese cars." You get the idea. At the time of making this video, US customs agents have just started collecting some of the new tariffs, although the full enforcement should begin on the 9th of April. Vietnam has already got Trump to agree to negotiations for a possible tariff removal, which was impressively fast. And this makes us wonder how long these tariffs will last in general, although there are now so many countries targeted that negotiating with all of them could take years. Now, amid all the doom and gloom, BTC only dumped by 3.1% on Liberation Day, but things got worse on Monday morning as it plunged well below $80,000. And there is nothing bullish about the BTC USDT chart at all right now. BTC has been in a strong downtrend on the daily timeframe since the 20th of January, and the fact that it's shown relative strength against US stocks has not changed this. A Liberation Day bounce up to the descending trendline was sharply rejected, as you can see from the wick on the 2nd of April. Satoshi himself could not hold this chart up for much longer, and unless the high timeframe trend is decisively broken, it looks like a slippery slope could be leading to the next significant zone of demand in the mid-$60,000 range. I would love to be wrong, folks, but you know what they say, the trend is your friend until the end. So, whatever happens, take care out there and try not to get liquidated as this game of 2D chess plays out in Washington. We'll keep you posted on the next moves in another video. But until then, why not check out the breakdown of the biggest heist in crypto history, and also human history for that matter, right over here. That's all from me for now, though. As always, thank you for watching, and I'll see you next time. This is Guy, over and out.